So you're trying to decide between using a Roth IRA and a traditional IRA. Maybe you can follow this really simple rule that most people have agreed on whether you should contribute to the Roth or whether you should contribute to the traditional IRA. Make sure that you stay to the end of this video because I'm going to include a real life example income calculation that's going to help you, put it into the perspective which one you should choose. And the simple guideline is to simply stay away from the 22% tax bracket and above, if you can. What this means is that you're basically going to use either the traditional or the Roth in order to stay away from a higher tax bracket. So the way that the tax brackets are currently structured right now, at least in 2021, is it goes from first 10% to 12%, and then from that 12%, it jumps all the way up to 22%, okay? So that's a pretty big jump, 10 to 12 and then 12 to 22. So the idea here is to try to stay away from that 22% tax bracket and above, because some of your money, when it's getting taxed at that high of a level, for every dollar you make, 22 cents of it is going to go to federal income tax. And so we want to stay away from that, higher tax bracket. If you are single, then the amount is going to be anything above $53,076, then it's going to be traditional. And less than that, it's going to be Roth. Less than $106,151, if you're married filing jointly, then go ahead and go Roth. Otherwise, go traditional. And if you're head of household, if you make less than $73,001, then go ahead and go Roth. Otherwise, go traditional. Now, how I calculated those income amounts, whether you're going to choose Roth or traditional, is I took the actual federal tax brackets, okay, and let me put that up on the screen for you so you can see that they start at 10%, then 12%, and then 22%. So right at the end of the 12% tax bracket, I'm going to take that number and then I'm going to add it to the standard deduction, okay, and that's going to give you your total income. So the end of that 12% tax bracket plus the standard deduction, that's going to equal the amount of income that's going to be taxed at 12% or less federally. Okay, any income after that is going to start getting taxed at 22%. So I'll go ahead and put that up on the screen for you really quick for the standard deduction. You can see that is the standard deduction in 2021 that gets added to the end of the tax brackets. And then another little thing I put together, a little chart, so you can see right here all at once. You have the 3 filing statuses, single, married, and head of household, and then the 22% tax bracket, where it starts at, and then the standard deduction is to the right of that. And if you add those two up, that's going to be the total income that's going to then get you into the 22% tax bracket. So you want to stay below that if possible. That's why single is $53,000, married is $106,000, and head of household is $73,000. Now, of course, if we're using those amounts, that's going to come with some assumptions. Everything has lots of assumptions. So in this case, the first assumption is that you're going to be using the standard deduction. Now, about 9 out of 10 taxpayers do use the standard deduction currently because the standard deduction is so high. But let's say that you're going to itemize. Well, the same rules are going to apply. So what you're going to do instead is you're going to just take the end of the 12% tax bracket. So for example, if you're single, you're going to take about $40,000, and then you're going to add however much your itemized deductions are. So instead of taking the standard deduction, which in 2021 was $12,550 for a single person, if you had itemized deductions that were higher than that, let's say you had $15,000 of itemized deductions, you're going to take the end of the 12% tax bracket, add that $15,000 to it, and that's going to be your new income that you're going to use. So if your income is above that, then you're going to want to reduce your taxable income by using the traditional IRA if you can. If your income is below that, then maybe it's better to stick with the Roth because you're not paying that high of income taxes. So more specifically, if you're single, it's $40,526 plus the $15,000. That's going to give you $55,526 of total income. If your income is less than that, then go ahead and go Roth. And if your income is more than that, then go ahead and go traditional if you are following this rule. Now, this rule also assumes that you're not going to get any other tax credits. Okay, so you very well could get some other tax credits that could drastically reduce your total tax bill. For example, the child tax credit is a very powerful tax credit that can substantially reduce your tax bill. So if you have children and you take the child tax credit, you could get anywhere from $3,000 to $3,600, just depending, in a tax credit. And that's going to take your bill way, way down. And therefore, it actually might incentivize you even more to use the Roth rather than the traditional because your tax bill is already very low. So your effective tax rate is going to be really low if you're getting one of those tax credits. But for the simplified example, we assumed no other tax credits. But if you are getting some tax credits, then maybe it's going to gear you more towards Roth even more. Another assumption is that it assumes no other adjustments to your income, using specifically Schedule 1. So Schedule 1 is going to be attached to your 1040, and that's where you're going to take some other adjustments that could possibly adjust your income up or down. So more specifically, if we're looking at adjustments that are going to adjust your income down, the traditional IRA adjustment is on that form. But there are some other adjustments that could possibly be made to your income. A really common one could be student loan interest that is paid. So you can deduct some student loan interest that is paid, and that's going to be on your Schedule 1. That's going to adjust your income down. So if you have some other adjustments, then just factor those adjustments into your income. And so if you have, an adjustment of an additional $1,000 per se, then you're just going to add that to that other income amount. And so your income can be a little bit higher, where it's still more advantageous for you to take the Roth IRA route and contribute to a Roth IRA over a traditional IRA. So as you can see, this is a pretty cool rule to follow, because you just want to stay out of that high tax bracket and get money into the Roth if you can at a lower tax rate. Now let's talk about the major benefits of both the Roth and the traditional. But before we move on to that, please make sure that you like this video and give it a thumbs up if you're enjoying it so far. It really does help me out, and I really do appreciate that. Plus, your like is going to help send this video to other people who really need to see this video. It's going to help the YouTube algorithm spread it. So thank you so much for hitting that like button. Let's first begin with talking about the Roth IRA benefits. So in most cases, the Roth IRA, having money in a Roth, is probably going to be better for most of us. And that's because a Roth IRA, if you're making a regular withdrawal from it, after the retirement age, then you're going to pay zero income taxes on that. So tax-free withdrawals. Tax-free withdrawals is the name of the game with the Roth IRA. That's one of the biggest benefits that comes along with it, is that you have high certainty that in the future, when you go to withdraw money from your Roth IRA, you're not going to pay any income taxes on that amount withdrawn. Another major benefit of the Roth IRA is that it has no required minimum distributions. So while you, the original account owner, are alive, you do not have to withdraw from your Roth IRA if you don't want to. And we're going to talk about that otherwise with a traditional IRA. But with a Roth IRA, you're not required to withdraw minimum distributions. So if you have whatever money in the Roth, you don't have to withdraw from it if you don't want to. Now, the drawback that comes with a Roth IRA is that you get no tax deduction today. You get no immediate benefits today. So contributing money to a Roth, you're not going to get an adjustment of your income like you would with the traditional. And speaking of the traditional IRA, that is one of the major benefits of the traditional IRA, is that you get to realize a tax deduction today in the current year that you are contributing to it. So generally speaking, unless you get phased out due to your income, you're going to be able to get a tax deduction or actually an adjustment to your income for the traditional IRA contributions. And that tax benefit today could be pretty substantial, because that means that you have less taxes that you're going to pay in this tax year, and that's more money that you can use towards your expenses, towards investing even more, or whatever you want to do with it. You get to keep more money in your pocket today. However, once you become retired and you actually start withdrawing from that traditional IRA, you're going to pay income taxes later. You're basically just deferring the taxes until a later time. Now, that can be very advantageous. Deferring taxes is a good thing, because that allows money to grow, bigger and bigger, because you have more money available to you. So if you're investing that tax savings, then you can invest more, and therefore your money could possibly grow to a very large amount. However, that leads to some uncertainty in the future, because we don't know what the tax rates are going to be in the future, and you're going to get taxed on the income that you withdraw from that traditional IRA in the future. And you're going to be guaranteed to get taxed on it, because traditional IRAs have what's known as required minimum distributions, one of those things that the Roth IRA did not have. So required minimum distributions, basically there's a formula to where once you reach a certain age, and currently in 2021 that age is now 72, once you reach that age, you have to withdraw a certain amount from your traditional IRA. And now there also are some similarities between the Roth and the traditional. So both, once you get money into there and you're investing into those accounts, both of them are going to grow tax-free. So whatever kind of dividends you get paid within those accounts, or if you sell off investments and you make capital gains, none of that is going to be taxed while the money remains in these accounts. So that's a very good benefit, and a substantial benefit for both of them. Also, the amount that you can contribute to both of them is going to be exactly the same, and that is currently, at least in 2021, $6,000 per year. If you're over the age of 50, then you can put an extra $1,000 in there, so up to $7,000 per year, and that's going to be per person. So a spouse and spouse, they can each contribute $6,000 each if they're under the age of 50. And then also, both of them can possibly qualify for a tax credit known as the Savers Credit, where if your income is pretty much in the lower range and you contribute to retirement accounts, then you could possibly get what's known as the Savers Credit or the Savers Tax Credit. And both of those Roth and traditional contributions are going to qualify for that. And speaking of those contributions, when you're contributing to an individual retirement account or an IRA, you have until the tax filing deadline of the next year to contribute to them. So for example, if if you're going to contribute to your 2021 IRA, whether it be Roth or traditional, you can wait if you want to until 2022 between January 1st and April 15th. Usually between those dates, you can contribute for last year's retirement. So the benefit of that is possibly that you can look back at your income and see exactly how much it was or how much you're going to pay taxes on, and then you can contribute to whatever's going to benefit you most at that time. So you can say, oh, you know what, actually I'm in the 22% tax bracket or above, and I can qualify for the traditional IRA deduction, so I'm going to contribute to the traditional IRA and reduce my tax bill. Or you can look at it and say, actually, you know what, my income is lower, and so I'm not actually paying that much in taxes, therefore I want to put my money into the Roth IRA and have that certainty of no taxes in the future. So it really comes down to how much taxes that you're going to be paying now when deciding whether you're going to contribute to the traditional IRA or to a Roth IRA. And this easy guideline to follow, I think, can apply to most of us in the median income range. Now, another thing that can really apply to most of us is another video that I created, a full guide to investing your way to financial independence. Now, if you haven't watched that video already, make sure that you watch that video. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.